Hey, Bowtie Nation, Joseph Hogue here. Thank you for joining me for another one of these live stream Sundays. Usually Beer Money Sundays. I've got coffee today though. Got to go lift after this, so probably not a good mix of beer and then lifting. But wherever you're at, grab your favorite adult beverage or whatever you're drinking, and thank you for being here again. See a lot of you long-term citizens of the Bowtie Nation out there already in the chat. Great to see Melanie, Ambrose out from New York, Rob. Thank you for being here again. I love doing these just every other week or so, just to kind of touch base with all you out there in the community, have an informal chat, take off the bow tie, and just kind of talk about what we're seeing in stocks and helping you plan that strategy. So, and this, it's a timely video, very important. Third quarter earnings started last week with the banks, and it really gets kicked into gear over the next few weeks, especially this next week. And if last week's market was any indication, it could be a great news for stocks, great news for investors, though there are some weak spots that you want to watch out for. So we're going to cover those. We're going to cover breaking down the market, what the market's expecting for these earnings. So those profits reported by companies, companies report their profits every 3 months. You've got the first quarter, which is January, February, March. April, May, June is the second quarter, and then June, July, August, and September is the third quarter, and that's the profits that they're reporting now. Just as important though, that as what they make with those profits that they report is what they say about the next quarter and next year. Okay, they always give the outlook, they always give guidance to how the business is going, and that is just as important as the actual earnings they report, because most of the time the market has a pretty good feel for how much they're going to report as far as earnings and sales and that kind of thing. They're more interested in hearing management talk about, okay, how is inflation affecting the company, how is the supply chain disaster affecting the company, and what does that mean for earnings going forward. So we're going to talk about that. See more people come in here on the chat. Good to see everybody. Joseph, John, good to see you here. Thanks for joining me. Again, just love being able to sit down and kind of talk informally with y'all on these Sundays. Before we get started, I did leave a link up there in the chat, and I'll also put it in the description box below, kind of making my 2022 plans as far as products and content and other things, and really want your input on it, really want your help in kind of getting an idea for what you want in 2022, not only what types of videos, but also if you want any particular courses, if you want to learn anything more in detail on anything. We've actually got a couple of questions in there about maybe starting a fund or something like that, kind of a Bowtie Nation portfolio that we can all follow and that kind of thing. So check that out. It takes all of less than 90 seconds really to fill out those four questions, and I appreciate it. So check out that link in the description below. Of course, we always leave room for question and answer. My favorite part of the live streams here. So let's get started. If you didn't catch them last week, we had some great videos, had the dumbest things said on Wall Street. And I guarantee if you follow stocks, if you watch any kind of YouTube videos on investing or CNBC or Bloomberg or anything like that, and obviously you do, you're going to hear these 10 things. You're going to hear these 10 things constantly, and they can be good sayings, they could be good rules, investing rules, but more often than not, they will lose your money. So make sure you check that out. That was Friday's video. I renamed it Financial Advisor Reacts to the Things Said on Wall Street, that kind of thing. Next week, coming up, we've actually got a review video of the most popular income ETFs. And these are ETFs like the QYLD, which is the NASDAQ 100 Covered Call ETF, the RYLD, the JEPI, a lot of these very high dividend yields up into 10 and 11% on them, and how they work, which one's best for your portfolio. So check that out. I think that one's coming out on Friday, actually. So check that one out. Make sure you don't miss that. But I want to get started on today's video. Looks like we're having connection issues or something. Let me know if I'm coming through all right with you as far as sound and video. But we'll get started. Okay. But again, very important over the next couple of weeks, what companies say about their earnings, what they say about the profits, and the outlook going forward. That's really going to determine whether we keep on making money in stocks or whether maybe the sell-off gets even worse. A lot of the sell-off there in September and early October was because the market was getting a little bit expensive. The market was worried about what's going to come out in these earnings reports, in these earnings releases, and it was really kind of scared about what that might say. So we're going to walk through here, and what I want to do is I want to show you, all you out there in the nation, you know about this resource. This is the resource that we're going to use today. So for totally free resource to kind of track earnings and companies and stocks. But it's called FactSet Earnings Insight. And the way you find it, anytime you want to find it, they update it. They update it every Friday during earnings season, a little less frequently, maybe every other week, every 3 weeks outside of earnings season. But you can always go to Google, you type in FactSet Earnings Insight, you click on there, and it's always going to be this first one. It's always going to be this first one. It's a PDF, so you look for the PDF, you look for FactSet Earnings Insight, and you can click on there. And it's this free report. Like I said, they put it out every Friday during the earnings season, and and that's what we'll be using today. But I'm going to close this out because I've already downloaded the one that we'll use today. And so what I want to start off with is kind of the expectations for stocks in this third quarter as those earnings come out. And the market is actually expecting stocks to post 27.6% earnings growth on a year-over-year basis. So earnings, those profits in the third quarter, are expected to be almost 28% higher than they were in the third quarter last year. Okay, of course, over the last few quarters, the earnings growth has been very high because they were so low last year, during the pandemic. Earnings were extremely low, so companies are still kind of building off of that low base. Now, typically, what you're going to see here is typically companies beat their earnings expectations. It is pretty rare. It's actually usually only about 10 or 15% of the companies that report earnings actually miss their earnings expectations and don't meet those numbers because it's all kind of a game, right? Management always has this opportunity to kind of talk down their earnings expectations, to say, you know what, we got a lot of inflation coming up, we got a lot of sales pressure coming up, things like that. So earnings are going to be somewhere around this range, okay, for the next quarter or the next year, right? And they play this little game because then Wall Street analysts look at these, they say, okay, you know what, we know management said this, but we think earnings are going to be right around here, so management tries to kind of manage that outlook, manage those expectations. So when they do report earnings, then they can beat those expectations, right? It's always better to beat expectations than it is to just meet them, right? Because a lot of management's going to be, their compensation's tied to beating those earnings and that kind of thing. So actual earnings reported for the third quarter will actually probably be closer to about 34% higher over the last year, which is extremely high. It's expected on about 15% revenue growth with about 12% net margins. And what I want to do is look into, by sector, really, by sector of the economy, because I think that's really where you start seeing, okay, which sectors, which groups of stocks are doing better, which might continue to do better, and which are the ones that you want to be investing in. Okay, so here we see the earnings growth outlook for Q3 2021. That's this quarter that's being reported right now, and you see in the blue is the expectations for earnings growth. Okay, so all the way over to the left here, we have the materials sector, and that is so materials are a lot of those mining companies, a lot of those basic commodities and inputs, right? And the market is expecting them to announce 90% earnings growth over the last 3 months compared to that third quarter of 2020. And of course, during that time, all those mines were shut down. Really, that sector was really shut down during 2020 because of the COVID, because of the virus. But you look at some of these other ones here. Industrials, so a lot of your factories and industrial makers, heavy equipment makers, expected to announce 60% earnings growth. So very strong earnings growth still looking at from these. You look at the other side of this, though. You look at the far right, utilities, all the way to the far right. Utilities are actually expected to report negative 0.2% earnings growth, this third quarter versus the third quarter of 2020. So, of course, why is that? Why are they expected to make less money than they did last year? And part of that is, part of it is higher costs for energy. The utilities companies buying buying electricity or buying the gas from their providers if they don't make it themselves, that kind of thing. But a lot of it is, third quarter of last year, we were all locked down in our homes. We were spending money on, the electricity and nat gas in our homes and stuff. So the utilities companies did very well last year, and they didn't see that sell off that we got from 2020 from a lot of the other sectors. So utilities actually expected to be the only sector, the only group of stocks to make less money over this last 3 months than they did in 2020. So very important there. Also, though, consumer staples, that those kinds of things that you have to buy, groceries, personal products, things like that, only expected to make about 1.1% more over the last 3 months than they did in the same period 2020. Consumer discretionary, which this one's kind of interesting because, we obviously consumer discretionary, all those companies, the retailers, the companies that sell things that we don't necessarily need, but we buy anyway, right? Those consumer goods products, they didn't have a good 2020, obviously, but they're still only expected to post about 3% earnings growth in the last 3 months on that year-over-year basis. That's something that I think can be is kind of lowered expectations. I mean, you look at some of these and you say, okay, do I believe in that expectations? Do I think companies will have an easier time beating those or might fall short? And consumer discretionary, I think, is one where I think we might be surprised on the upside. People are getting out of their houses, they are spending their money. So I think consumer discretionary stocks can do better than that. But overall, like I said, they're expecting the S&P 500 stocks in the S&P 500 to post 28% earnings growth over the last year. And again, those bank earnings that we saw last week were very positive. Overall, Wells Fargo showed a little bit slower loan growth and actually fell, a few percent on its earnings, but was weird because it jumped like 7% the next day, especially on a lot of these other banks, the JP Morgan, Goldman Sachs that reported very strong earnings. A lot of you that have been following the channel, I'm very positive on banks and the financials in general over the next year. I think we're going to still see those. We're going to continue to see the same thing that they talked about in those earnings statements over this last week. We're going to continue to see them report that over this next year. Higher interest rates means they make more money on their loans. I think we're going to eventually start seeing more loan growth, more people getting loans and more businesses applying for loans, that kind of thing, over this next year. And of course, the capital market side of the business with the investment banking and that kind of thing will do very well as well. So it's really that last week was about the banks. This week it really broadens out. We're going to see a lot of those other sectors report their earnings this week and then over the next couple of weeks. And that's the important part. That's the part where you start seeing, okay, are all these companies talking about these supply chain issues? Are they talking about worker shortages and inflation? And is that going to hit, hit stocks? We had a very good signal from Alcoa, which is an aluminum manufacturer. This last week, shares shot up 15% on their earnings. So, it was good to see a company outside the banking sector, outside the financial sector and the banks report some really good numbers, and for the market to the market to keep that positive sentiment and send those shares higher. Now on that one, on the Alcoa earnings, that was actually mostly about them reinstating their dividend. They hadn't paid a dividend since like 2016, so they increased their dividend and actually added to their share buyback program. So that's where a lot of that 15% upside came from on that. But their earnings were still good. What they said about the outlook, the future was still good. So I think that was still a good sign for what we'll see with a lot of these other companies. Now, before we get to some valuations as well as the best and worst stock picks according to analysts and the best and worst sectors according to analysts, I want to cover just some of the issues that you want to watch for if you're going to be watching these earnings reports or reading news on these earnings releases for the companies that you own, for the stocks that you own. You really want to be watching for a few things here. And one is what they say about those supply chain issues, what they say about worker shortages and inflation. Okay, these are the three biggest issues right now that could really send stocks lower. Okay, the supply chain. If you haven't heard, there are dozens of ships anchored outside of especially LA, but even on the East Coast, just waiting to be unloaded. The truck driver shortage and the problem in trucking right now is really making it difficult for companies to get the products that they're ordering from the manufacturers to their retail outlets and things like that. So, and it's a really big worry because one, it's just making everything more expensive. It's adding to those inflationary pressures. It's adding to those costs. But two, we're coming up onto the Christmas holiday season, the holiday shopping season, and if stores don't have enough product to sell, if they're running out of product, then that's a missed opportunity. This fourth quarter is really the quarter for a lot of retailers, for a lot of consumer discretionary companies to come into the black, to balance their books and start turning a profit. And if they just can't get the supplies, and the products on their shelves, then that's going to be a major issue for these companies. Obviously, worker shortages is a huge one. And in fact, in tonight's weekly bow tie, a weekly newsletter goes out every week, Sunday night before the market opens the next day, kind of talks about some of the major issues we're seeing in stocks and some of the stocks I'm watching. So, the link to that is in the description below, totally free. Just sign up for that and you'll get that every week. But anyway, in tonight's issue, one of the things I talk about is that worker shortage and, how we need to transition, not from just asking why it's happening, why so many workers are quitting, why are there 11 million job openings for just 8 million unemployed workers? Why are people not coming back into the workforce? We need to go from asking why to what it's going to do to companies, what it's going to do to stocks. Okay. Because this issue isn't solving itself. It isn't coming out. So we really need to start asking ourselves, okay, how does this affect stocks and how do I need to invest? Knowing that, the worker shortage, obviously, one of the biggest effects is it's going to have on wages. Wages have to go up to get these workers that don't want to come back to the office, back into the shops, into the factories and that kind of thing. And especially with the retail group, with those retailers, with the restaurants, they're seeing a crisis here in workers. So they're really having to increase their wages. And not so much this third quarter, though they will talk about it, but especially the fourth quarter and next year. You're going to start seeing earnings come down maybe a little bit because companies are having to pay more with worker wages. So, they're going to kind of squeeze those margins a little bit, squeeze that profitability. And of course, all this is flowing into that inflation issue as well. 71% so far, 71% of the companies that have reported their earnings have cited kind of negative impacts from the supply chain issues, from inflation, from some of these other factors. So what you really do need to watch when management is talking about their third quarter earnings is what are they saying about these three factors, and how is that going to affect the stock and the company over this next quarter and over the next year. Now, again, market is expecting about 9.7% earnings growth and 6.8% revenue growth next year. So what we're going to start seeing the market talk about, and this is the thing, folks, you always got to be, as an investor, you always got to be thinking about, okay, what's the market going to be talking about next? What is the next big issue, okay? Because generally, and like I said, all the third quarter earnings, the earnings and profitability that companies are reporting right now, in all these current issues, they're already reflected in the stock price. Analysts know pretty much more or less what a company is going to report as far as profits, as far as sales. So as your job as an investor, if you're trying to pick individual stocks and trying to make a little bit extra return, you need to be thinking, okay, what's this next issue? What's the next thing that the Wall Street is going to be talking about? Okay. And part of that is this slowdown in earnings growth. Okay. So this year they're expecting about 25% earnings growth for the S&P 500 companies, which is huge. To grow your earnings, 25-30% in a year is huge. But it's going to be slowing down. It's going to be slowing down to less than 10% next year. So, people are going to start getting worried about those valuations. Speaking of the valuations, we can look at those here. Let's shift over to FactSet, and this is 29. where are we here? So that's 17. 26, 27, 28, 29. And you can look here. This is the PE ratio, the price to earnings ratio on stocks in the S&P 500, the broader market index. And you can see it's right at around 20, right? The forward PE, which is the price of all the stocks in the S&P 500 divided by the expected earnings over the next year, right? And that's right at about 20.5. Okay, that's the dark blue line here. And you can see that is well over the 10-year average, which is that blue dashed line, and as well as over the 5-year average, which is the green line here. Now, what to understand here is, so that's about 25% premium. That's about 25% more expensive than it has been over that last 10 years. It's even, if you're going off the 5-year average there, just above 18, it's still about it's still about 12, 15% more expensive than it has been over the last 5 years. So stocks are expensive right now. That valuation is coming down a little bit, as earnings continue to grow at those double-digit pace, as earnings grow at 27% this quarter, and I think it's expected something like 15 or 18% growth next quarter, then, unless stock prices just jump along with it, if earnings go up 20%, and stock prices only go up 10%, then obviously this price to earnings is going to come down a little bit. It's going to become a little bit closer to those averages and not quite as expensive as it is. So, you're looking at a market that is extremely expensive. It's 25% more expensive than it has been in the past on average. But understand that, earnings continue to go up, and they become less expensive because it keeps on going. Now, what I want to do though is, it's always best to look at this sector level, like we've been doing. So here I want to look at the PE ratios for each sector, for the sectors, and that gives you kind of a better idea of, which stocks are more expensive, which stocks are less expensive. If you're a value investor, obviously you're going to want to look to those less expensive sectors to make your money. If you're a growth investor, investing in growth stocks and tech and that kind of thing, you're willing to pay a little bit more on that price to earnings basis. Maybe it doesn't matter to you quite as much, but it still pays to know, at the sector level, which sectors are expensive and which aren't. So we can go in here and, consumer discretionary trading at 29.7. So what you're looking at here is the dark blue line is the current price to earnings ratio for all the stocks in that sector, the S&P 500 stocks in that sector, so the largest U.S. companies. The green line then is the 10-year average, right? And you can see that almost all of these are higher than their 10-year average, okay? The blue line here is higher than the 10-year averages. That means the stocks are more expensive in that sector than they have been over the past 10 years, over the past decade. The only exception is energy still. Okay, if you look all the way over to the left here, the green line, so the 10-year average PE ratio on stocks in the energy sector was 15 times, okay, 15 times price to earnings. They're right now trading at 13.4 times, right? So, even though energy companies, oil companies, companies in that space have come up like 30% this year, and some of the biggest gainers in our 2021 portfolio from that sector, even though they've come up so much, they're still trading relatively cheaply, under those valuations, which is why I'm still positive on stocks in the energy sector. I think, you're going to start seeing a lot of big dividend increases in oil company stocks, in stocks in the energy sector, simply because a lot of these oil companies, they're getting tons of cash flow. They're getting waves of cash flow from $80 a barrel oil, but they see the writing on the wall. They know that 5-10 years from now, oil production or oil demand is going to be a little bit lower because of electric vehicles and alternatives. So they're not really investing quite as much in new production. They're not looking for those new fields or developing those new oil fields. So they've just got this immense amount of cash flow that is coming in and is not spending. So I think here, especially this quarter, so this quarter that they're reporting now, over the next couple of quarters, you're going to start seeing some big dividend increases and share buyback programs from a lot of these energy companies. So definitely be watching for that. I think it's going to come through on some pretty nice returns for stocks in the energy companies. But you look at some of these other sectors here, financials. Here, this This second one over from the right. Stocks in the financials, so your banks, your insurance companies, trading for 14.6 times on that price to earnings basis against a 12.7 times average over the last 10 years. So not that expensive on that one as well. That's about two. That's about 8%. Or no, about 12% more expensive, 12, 13% more expensive than it has been on average. And again, like I said, I think the banks can do very well over the next year on those rising interest rates. They make more money on those loans, and loan demand is gonna be increasing. So, if you're a value investor, definitely in the financials, in the energy sector, there probably some pretty good returns there. Materials and healthcare also trading relatively cheaply. Healthcare at 16.6 times earnings, materials at 16.1 times earnings against 10-year averages right around 15.3, 15.9 there for those two. So relatively good valuation. I mean, if you look at the overall stock market and you see it's 25% more expensive now than it has been in the past, you get a sense that stocks are just expensive. Stocks are too expensive to buy. But if you look at this sector level, you really can get a sense of, okay, where can I buy that isn't quite as expensive? And you definitely see it in these, in these four, definitely at least in these four sectors: energy, financials, materials, and healthcare. You come over on the other side here, consumer discretionary, still trading at about 50% more expensive than it has been in the past, at that 30 times earnings versus 20 times earnings on a 10-year average. Information technology, so all your tech stocks, still trading at about 25 times earnings versus 17 times earnings, which is the average. Now, I think this is a tale of two different stories here, right? Now, consumer discretionary, it is extremely high. It's 30 times earnings. It's 50% more expensive than that long-term average. But this is where you're really seeing a lot of that growth, a lot of that earnings growth, I think. The earnings were so bad last year that, and the fourth quarter of last year, that I think over this next year, the earnings are going to be so much better that price to earnings ratio is going to come down for a lot of these consumer discretionary stocks. The prices will continue to go up, but the earnings are going to go up so much faster that's not quite as bad a deal as it appears here. Not quite as expensive as these stocks here. On the other hand, if you look at the IT sector, the tech stocks, right? Tech stocks had a very good year last year for the most part. Their earnings didn't take that huge hit from the pandemic. In fact, a lot of them reported higher earnings last year, and yet it's still trading at 25 times on a price to earnings basis. So that gives you kind of a sense of how expensive really that tech sector, that those tech stocks are, that the earnings didn't really get hit that badly, but yet that's still extremely expensive. So I don't think you see the kind of earnings growth in the tech stocks in the IT sector that you see in some of these other sectors over the next year. So maybe you don't worry too much about it if you're a tech investor or a growth investor. Maybe you look at those price to earnings to growth ratios more. But it's definitely something you want to think about. Let's go real quick over to this the earnings expectations for next quarter, for the Q4, because I think it's another thing that you can look for and kind of get a sense for what the market is looking at and where you need to be invested. So this is, let's see here, this is the Q4. Okay, so these are Q4 earnings. Earnings for next quarter, what's expected right now from Wall Street. Again, we see materials and industrials really leading the pack. Okay, so this is that dark blue line here is the earnings growth expected to be reported by S&P 500 companies in each sector for the fourth quarter. Okay, and so these are going to be reported in January, February. They're going to be reported. These are the profits for the next 3 months, right? October, November, December. And again, just the earnings growth expected out of the industrials and the materials sector is amazing. 61% earnings growth out of materials, 126% earnings growth expected out of industrials. And so you get a sense of, okay, if they're expecting earnings to grow this fast, profits to grow this fast, and then you can go back down there to those price to earnings ratios, and you see materials is one of the cheapest sectors right now. Okay, so it's a relatively cheap sector, plus earnings are growing very quickly. I think that makes materials one of the best sectors to look at, to invest in here over the next year. Is we're expecting this kind of earnings growth. We're expecting this kind of earnings growth. Stocks are already relatively cheap in that sector, so that's where you want to look for stocks. You can also look on the far right here and look at some of these sectors that are expected to post extremely low earnings growth, right? For the fourth quarter. So for the fourth quarter, the market is expecting 22 times or 22% growth from stocks in the S&P 500. So that broad general market, analysts are expecting 22% earnings growth over this 3 months, this October, November, December, reported in January. That's what they're expecting. So really, anything under that is, underperforming the market as far as earnings growth. And you look here on the right, utilities expected to post negative 4% earnings growth, which is really amazing, considering, the economic growth, 6-7% economic growth. And yet utilities companies in that utilities sector expected to make 4% less during these 3 months than they did last year. Okay. Financials also expected to make 1.8% less. I think that's where, again, that's where the market is wrong. I think you can make some pretty good money in financials because the market just isn't expecting anything. The market is expecting them to lose almost 2% on their profitability compared to the fourth quarter of 2020. And I think I just don't think that's going to happen. I think they're going to continue to make more money. Utilities companies, I think I would stay away from, as well as consumer staples, just because those rising interest rates really draw investors out of those stocks. With interest rates going up, then those utility companies, those consumer staples companies, a big part of the return there is from their dividends. That's their attraction. That's their main attraction for investors. So as those interest rates go up, then investors start saying, well, you know what? Yeah, I like this 2-3% dividend yield from this utility company, but I can get that same dividend yield from a bond or from something else, from interest rates, and with less risk. So they start coming out of those stocks. So that's really something you want to watch for. Now, I want to cover, before we get into the question and answer, I want to cover what most of you are probably here for, the best stocks to invest in and the best and worst companies according to analyst estimates. One of the best parts of this FactSet earnings insight that they always show is the sector level target prices, so sector level returns expected, as well as the companies, the best and worst companies as far as estimated returns. Okay, so first let's look at this sector level bottom up target price versus closing price. Now what this is each sector, so the 11 sectors of the economy, as well as the S&P 500 is shown there as well. This is the difference between the target price on all those companies in each sector from analysts, right? So FactSet surveys all the analysts, a lot of the analysts on Wall Street. They ask them what their target price is for each company in the S&P 500. Now, what you see here is the difference between that target price and the recent closing price. So obviously kind of a 1-year expected return on each of these sectors. And then we'll look at the stocks next. And what you want to do here is you can do two things. One is you look at, okay, so where does Wall Street think that the highest returns are going to be? And should I be investing in those? And if you're doing that, you're looking at things like communication services. Clear over here to the left. Analysts are expecting 18% return on stocks in the communication services sector. And I'll show you how to find some of these here in a little bit. But stocks in the communication services sector expected to return about 18% on average over this next year. That's going to be things like your telecom companies, your internet companies, things like that, social media. They're also expecting materials. So we've talked about materials a lot during this video. They're expecting about a 17% return out of material stocks over this next year. You've got information technology, so tech stocks, and healthcare. So those top four, you've got communication services, materials, information technology, and healthcare, all expected to post above 16% return over this next year. Okay, so if you think analysts know what they're doing, if you want to follow them on those sectors, then you can go into each sector, pick out some stocks in there, or just invest in the broad sector itself. And I'll show you how to do that pretty soon here. If another way to do this, though, another way to use this chart is to look at where the market might be wrong, where there's that opportunity that the market doesn't quite see yet. Okay, so you go over here to the right and you see, okay, where do analysts not really expecting too much? Where are they not watching over this next year? And you see, okay, financials. Analysts only expect about a 7.8% return on stocks in the financial sector. And a lot of this, you see right next to it is energy with an 11.5% expected return. So both of these sectors, not expected to do much over this next year. And a lot of this is just because analysts haven't upgraded their targets prices yet. Both of these sectors have done extremely well. They're both up like 30% on the year. So analysts are maybe getting a little bit fearful of where those stock prices are going and that kind of thing. But if you look at these and you think, okay, are the analysts right? Are they wrong? Maybe are there things that will continue to drive these stocks higher over the next year? And I think for both of these sectors, there are. You've got the financials, which, like I said, already reported a lot of their earnings last week. Did very well. They're making more money on those loans because of those higher interest rates. They're making very good money on bond sales and other investment banking, so IPOs, things like that. And really about the only weakness in the financials right now in the banks is that loan growth, that loan demand. There's really just people just aren't needing that money right now, right? They've got tons of money saved up from over the last year, so they're not taking out as many loans as they did in the past. Well, now you think, okay, what's going to happen next year? What's going to happen over the next 4 quarters? You're going to see interest rates continue to rise. That's positive for the financials. You're going to see, you're probably going to see that loan demand, that loan growth continue to increase. So that's going to come back a little bit. And I think you're going to see these financials, the banks and the insurance companies still continue to do very well and continue to surprise this what Wall Street actually expects them to do. So I think financials is one where you can get some surprise there and upside. Energy. Again, it's done so well this year that analysts just don't expect quite as much next year. Quite as good of a story. And we can go here and look at how well it's done. Anytime you want to find a stocks in a sector, you want to look deeper into a sector, then you can go to the sector tracker. I've got mine here up here in my bar, but you go to the selectsectorspiders.com, sectorspider.com website, and you go here to tools, and you go here to sector tracker, right? Great resource, another resource I use on a daily basis, and it's going to show you, all 11 sectors as well as the stock market in general. You can see how they did over the day, over the 5 days, 1 year, 5 years. Let's change this to year to date. And we can see how these sectors did. Energy sectors, stocks in the energy sector did 51% so far this year, which is just amazing. It's a huge rebound. Financials just under that did 34% so far this year. The top 2 performing sectors right now, energy and financials, and so that's a lot of the reason why you see analysts, are a little bit more negative or bearish on those 2 sectors, just because they have done so well this year. Now, in any of these sectors, if you click on them, so we'll click on energy, and you can see all the stocks in that sector. You see all the S&P 500 stocks in that sector. You can see how they've done during that time period, and you can kind of get a sense of, okay, which are the best ones in that sector, which are the worst ones, which are the ones that haven't done as well. So, maybe you invest in those on a rebound play kind of idea, but you can do that. And again, for energy, I think energy is going to be one to continue to surprise the market over the next year. I think, like I said, I think a lot of these energy companies, they're making boatloads of cash on these high energy prices, these high oil prices, high natural gas prices, but they're not spending it. They're not developing new fields, and they're not doing that development spending. So what do they do with that cash? They return it to investors. They buy back their shares. They increase their dividends. And I think that alone is going to really drive these stock prices. We already saw it in Alcoa last week, 15% up on Friday, shares of Alcoa, because they did reinstate that dividend. They increased their share buyback program. And I think that's what you're going to see from a lot of the energy companies over this next year, over this next few quarters. And so that's one reason why you maybe even after this 50% run so far year to date, maybe you stick with some of your energy stocks. But you can look through here and see what the market expects from some of these. Now I want to look at, let's see, actually I think it's higher up. Another resource here in FactSet is you can actually see where the companies with the highest upside potential according to analysts. Okay, so here what we're looking at, this first chart here is the difference between the target prices and closing prices and the top 10 for returns. Okay, so again, FactSet surveys a lot of the analysts on Wall Street, ask them what their target price is for each company in that S&P 500 index. They look at the closing price so far and they rank them. Okay, so where do we see the highest potential return according to analysts? And these are the top 10 right here. And what you see, okay, so Western Digital Corporation, that's ticker WDC, 60% upside on the median target price. Now, this isn't the highest target price. This isn't the lowest target price among analysts. This is the median, okay? So if they have, 10 analysts giving a target price for Western Digital, they would take the average between, the fifth and the sixth one, kind of get a median price, so kind of a middle price for those target prices for these companies. So it could go higher, could go lower, but it's right around that 60% upside return on those. Very strong. Western Digital tends to be kind of volatile. Haven't covered it a whole lot on the channel here. This next one is one that I have looked at, and we actually added Las Vegas Sands, ticker LVS, to our 2021 Bowtie Nation portfolio there last week or the week before. Now, Las Vegas Sands, between the closing price right around $37, when this issue was put out on about a week ago. So $37 per share, median target price of $58 over the next year, right? So a difference of 56% on shares of Las Vegas Sands. And Las Vegas Sands is really interesting because they just made a deal to sell off their Las Vegas assets, right? They're going to be selling off those assets, using that money to pay down debt and make acquisitions. But they're going to be focusing more on international gambling, okay? Macau, Singapore gambling, that kind of thing. And where I think this is interesting here is because I think what we're going to see here over the next year, I mean, Las Vegas is already back. Las Vegas is already gambling and making money. But a lot of the other countries, a lot of that international gambling hasn't quite rebounded quite like we've seen Las Vegas and some of the sites, some of the casinos in the U.S. So I think the recovery or the rebound potential in those international casinos, that international theme is still much higher, which of course, Las Vegas Sands is going to be focusing on that. So I think that's where you see a lot of this return potential that analysts are looking at here in Las Vegas Sands. So you see that you've got Insight Corporation, you've got Biogen, Moderna, you've got a lot of these pharmaceutical companies, which are always kind of more risky. It's always a riskier bet because, you've got these pharmaceutical companies where, especially the smaller ones like maybe Insight, maybe Moderna or Vertex Pharmaceuticals there, where a lot of it hinges on one drug that they're developing. With Moderna, it all hinges on that COVID vaccine. But with a lot of these, so I mean, if they get the approvals for all of these for these drugs, these drugs that are in FDA trials, then you could see some very strong returns from these. So Insight, Biogen, Moderna, Vertex Pharmaceuticals, all there in the top 10 according to analysts. Now, what analysts are looking at here is obviously they're more positive on the FDA trials, the drug trials for each of these companies. They're saying, on average, they think that those drug trials are going to go well and they're going to make good money, and that's where you're going to get that return from. Whereas, maybe some other drug companies, they're not quite as bullish on those trials. But you got those. You got Activision Blizzard here, which is actually another one that we added to the portfolio a few weeks ago. This Activision Blizzard, obviously a big game maker. I believe it's got some of the big franchises, the FIFA franchises with Activision Blizzard. And they've come under pressure lately. A lot of these game makers have come under pressure over the last month, but analysts see Activision Blizzard doing 48% upside over the next year. Target price of about $115 on average for the median target price there among analysts, trading right around $77 a share now. So they're seeing almost a 50% upside on that. Under Armour, also another one. And what you got to understand here for a lot of these is, a lot of the stocks may have sold off, and those analyst target prices maybe are a little old. So some of these might get downgraded a little bit. But my thinking on these a lot of times is you look at these companies, and analysts were thinking they're worth this much. New information comes out, and yeah, it can affect the stock price, but is it still the same company? Is it still relatively the same company? Should it still have closer to that target price of, in Under Armour's case here, $27 a share, rather than the $18 per share closing price where it is right about now? Under Armour, it's one I haven't covered very much in the past. I have some Under Armour shirts. They're good shirts. I like them. Tend to be a little bit more expensive than I want to pay for a shirt for some workout gear. I'll just wear a t-shirt, just a Hanes t-shirt, all the same. But 47% upside expected in shares of Under Armour. Some other ones here. One more I want to cover here, and then we'll look at the 10 worst, actually. The 10 worst returns. Tapestry. Here, this last one here, Tapestry. It's a luxury retailer. It owns the brand names for Coach. It owns Kate Spade. So some of those luxury accessories like handbags and things like that. Trading right around $38 a share. Analysts, on average, median target, have a target of $55 a share over the next year. It's about a 44% upside. I'm actually doing an update to our 2021 Bowtie Nation portfolio. Haven't added the shares yet to the portfolio, but we'll be adding those this week, just because. Like I said, I like that consumer discretionary space. I think it's going to beat our analyst expectations over this next year as people start getting out, start spending their money. And what I'm looking at here, what you want to look at in consumer discretionary stocks, in those retailers, those resorts and hotel stocks, things like that. You want to look at the customer segment that they're serving, okay? You want to look at, how strong are the brand names? Are they luxury brands, or are they kind of discount brands? And what I'm thinking here is, over the last year, for higher income people, the higher income demographic, people making more money, people with more money invested, it's been very good. It's actually been a very good time for people in that demographic, in that segment, because one, their jobs were more likely to be able to do at home, right? So they didn't get laid off. They kept on making money. They were able to have that work from home environment. So they kept on making money. The stock market, they had money in stocks, which has obviously done very well. So that high income demographic, that high income segment of people has done very well over the last year. And that's the group that we see that have saved up a lot of money, about $1.7 trillion in household savings, according to JP Morgan. And a lot of it is in that segment. Now you come on the other side here, though, the discount segment, the lower income segment of the population. These are going to be, more likely to have had to go on unemployment because, maybe they got laid off from retail, from restaurants, or from some of those lower paying jobs, right? Maybe they didn't have quite as much money invested in the stock market, so they didn't benefit from stocks going up so high. And again, here, this is where you see a smaller portion of that savings, that $1.7 trillion saved up by households. This is where you see a smaller portion of that, okay? So what I'm thinking here, when I'm thinking about what stocks to invest in that consumer discretionary space, in that area, is that, okay, the ones selling those luxury goods, those luxury brands, like Tapestry here, selling Kate Spade handbags, and Coach, and a lot of these luxury names, they are going to be doing very well as those higher income people get out of the house, start spending more money, and start spending the money that they've saved up over this last year. Whereas discount retailers, your dollar stores and things like that, your TJ Maxx stores, they probably aren't going to be doing quite as well, okay? Because their customers, the people that shop at those stores, haven't done quite as well over the last year. So that's really something I think if you're going to be investing in retailers and consumer discretionary, something you really do need to look at and really do need to watch. So those are the top 10 here. And again, this is all available for free on FactSet Research, Earnings Insight. You just go into Google and look for it, and you can download your copy there. The 10 worst now. And again, I like to look at these, not so much always to see, okay, which companies to avoid or even which companies to invest in, but why these are here, what this is saying about those companies or even that sector. Okay. So if you look at the 10 worst, you look at Lumen Technologies, Xilinx, Ceridian, Marriott, Paycom, and what you're going to see, I think, is a lot of these. You're going to see a lot of these have increased so much. The share price has run up so much over this last year or so that it's a valuation idea, right? The analysts, have said that their target price for the stock is this. The stock has already boomed through that target price, and they just haven't increased the target price just yet. So they're not expecting the shares to do so much because they're already kind of overvalued, kind of expensive. Now, a few of these that I would kind of wonder about, and this is always just like we looked at the sector level, just like we looked at some of those stocks, you got to think, okay, where is the market wrong? Where are analysts wrong about these stocks? And does that mean that surprise that when that comes out, does that mean that surprise is going to lead these stocks higher than expected? So some of these, Marriott International, I would wonder because, as that traveling comes back, then are these shares going to do better? So I would want to look at Marriott International, look at that stock, look at how the stock price is done. If it hasn't come up too much, over the past year, then maybe I would want to look at that. Now I know with hotels, with airlines, they're still very much hurting because the business traveler hasn't come back, because the international travel hasn't come back, right? Consumer travel is even higher than it was back in 2019. So consumer travel or domestic travel, excuse me, domestic vacation travel, that kind of thing is higher than it ever was. Okay, so it's doing very well there. But a large part of the sales and the earnings from these companies, from the airlines, from the hotels, things like that, are that business traveler, are the international traveler, and that has yet to come back. So there might be something to think about here. Marriott might not do quite so well if that business traveler doesn't come back and doesn't start helping them make money over the next year. Robert Half International is kind of a surprising one because that's one I'm kind of bullish on because, obviously as companies start having more difficulty trying to hire people, they're going to turn to these staffing firms. They're going to turn to Robert Half International or Manpower. They're going to turn to these companies to try to fill those staffing gaps, try to fill that worker shortage. So maybe it benefits Robert Half International. Maybe it doesn't. Maybe there's something here that I'm not seeing. I haven't looked at the stock haven't looked at it in a couple of months. So I would want to really look back on that and see what's why analysts don't think that it's worth more than about $100 a share. So those are the worst 10 though, and you see some of these, right around 7%, 6% loss, 13% from the target price, from the closing price to their target price there. Now I want to open this up to question and answer. It's always my favorite part of the part of the live stream here because I just get to relax and answer your questions, see what you're talking about there. I already see some questions